Most investors think a stock trading under 5 is automatically junk, or even worse, the type of stock social media gurus pump up just before they dump it on you. That preconception exists for a reason. There really is a lot of junk in the under 5 stock aisle, but not always. Every so often, a real business with real revenue and profit ends up trading at a low price because the rest of the market just hasn't caught on yet. So I went looking for them. I ran thousands of stocks through our proven quant model, and I pulled out 5 special tickers trading under $5 a share that actually score higher than some more well-known companies. One of them just posted record results and is booked solid for the rest of the year, pointing to even more growth ahead. Another has a truly unique connection to the defense niche. And as always, I'm saving the best one for last. In this case, Wall Street is completely ignoring the stock, which hides a hidden gem in plain sight. Hey, I'm Steve Reitmeister, but all my friends call me Righty. I spent nearly 20 years as editor-in-chief of Zacks.com, and today I'm a partner at WallStreetZen, where our quant rating system analyzes a wide array of data points to separate the best opportunities from all the noise and nonsense. If you find this kind of stock research useful, then do me a favor and hit that like button. It tells the algorithm to push more videos like this into your feed so you get more real analysis and fewer hype reels. Before we get into the names, the usual reminder, and it matters more than usual with stocks of this nature. Everything here is for education purposes, not personalized investment advice. Penny stocks carry real risk, and they can move hard in both directions. So please do your own due diligence before putting your hard-earned money to work in any of these stocks. Now let's dig in with our first under 5 pick in Jerash Holdings, the symbol of JRSH. Now the company doesn't do anything groundbreaking, but they're quietly exceeding Wall Street expectations, which often point to future share price outperformance. Jerash manufactures and exports clothing out of the country of Jordan. They do that work for some of the biggest brands on the planet. We're talking about North Face, New Balance, Skechers, and American Eagle. If you've gotten a jacket or a polo from one of these labels in your closet, then there's a decent chance it came from Jerash product line. Here's why it's interesting right now. Jerash just closed out its strongest fiscal year on record, swinging to a clear profit after a year in the red. Now, the turnaround includes a fresh earnings beat where they came in well ahead of street expectations. The turnaround seems to have legs because its factories are booked solid through the end of the year. This led management to guide the current quarter's revenue up by nearly 20%. Now, this is a company with more demand than it can physically produce, which is a good problem to have, often leading to robust earnings growth. Our Zen Ratings quant model supports the bullish case for this stock. Jerash carries an overall rating of A, which is a strong buy recommendation. That's because it scores in the top 4% of all stocks for its attractive fundamental profile. There are also 7 component grades underneath the headline rating. The benefit is to show more clearly the strength and weaknesses of any stock. There are several areas of strength worth noting for Jerash, starting with value, which lands in the top 17% of all stocks tracked. Remember that our value score is based upon 21 different measures of value, right? But even more impressive, it ranks in the top 2% of stocks for growth, which bodes well for more earnings beats ahead. Then we have a top 1% score for sentiment, which says the smart money is already circling around this stock. The risk is straightforward. Nearly all of Jerash's operations sit in one country, Jordan. So any geopolitical disruptions in that country or changes to tariff policies would likely hit results pretty hard. But the bottom line for Jerash is that we have a turnaround unfolding, pointing to greater earnings growth ahead, plus the excellent value, growth, and smart money sentiment unearthed by the Zen Ratings review. All that in a stock trading under $5 per share. That's a pretty good start to our conversation today. Now we're going to go from a clothing maker in Jordan to a gold mine in West Africa. But first, if you like discovering hidden gems like these, then you can get even more by joining me every Monday at 7 p.m. Eastern Time. That's when I host my free weekly live training sessions with timely market insights and top stock recommendations. It's totally free, but you do need to register now. Just go to WallStreetZen.com/live. Back to the parade of stocks under 5 as we move on to Galiano Gold with a symbol of GAU. Now, as you probably know, gold has enjoyed an incredible multi-year run. This was followed by a hefty pullback that many suspect is an enticing buy-the-dip opportunity. When people allocate to gold, they either buy the solid metal or they go for the giant miners. But really, the bigger upside is often hiding in the smaller producers, the ones whose profits soar the most when gold prices move higher. Galiano perfectly fits that bill. Too often, smaller miners are burning cash or gambling on a new deposit that may never pay off. Galiano is one of the fewer smaller operators that's actually profitable given their low-cost production in Ghana. That is exactly what you'd want if you're going to play a sector this speculative. Now, as you would expect in a company this small, they have pretty thin Wall Street coverage with only 2 analysts recommending shares. However, as of the week I'm recording, both the analysts have price targets that imply upside of more than 100% in the year ahead. Now let's look at the company through the lens of our quant rating system. Galiano earns an overall Zen rating of A, a strong buy recommendations. Its fundamentals rank in the top 3% of the 4,600 stocks tracked in the system. As we look at the component grades, we will see a generally well-rounded profile. For financial strength, it ranks the top 21% of stocks we track. Then we have a top 20% showing for sentiment and top 11% for growth. But its standout grade is value, where it lands in the top 6%. That matches up well with that lofty Wall Street fair value target price, right? Where it gets dinged is safety, which earns a D grade in the bottom 20% of all stock, and that's an honest trade-off here. Gold mining is volatile, as the stocks move greatly based on the day-to-day price swings in the underlying metal. So if you suspect gold will bounce back towards the previous highs or even higher, then adding a quality gold miner would be a very wise choice. Hopefully, you now appreciate why Galiano could be the perfect pick. Let's keep the party moving with the stock number 3 in DHI Group with the symbol of DHX. Now, to avoid any confusion, I will be calling it by the ticker name DHX because there is actually another stock out there with the symbol of DHI. Okay, this company might seem pretty boring on the surface, but as we dig deeper, it actually has one of the more interesting setups on the list today. DHX runs specialized job boards. Their two platforms are DICE for technology professionals and Clearance Jobs, which is the part that I'm going to focus on. Clearance Jobs is the go-to hiring marketplace for people who hold U.S. government security clearances. Think defense, intelligence, classified work. You can't just fill those roles on the general job website, and that's exactly the economic moat that we're talking about here. And here's the catalyst. With defense and government spending climbing, demand for cleared talent is climbing as well. DHX just expanded clearance jobs deeper into the world by acquiring a defense staffing firm with its own top secret facility clearance. That lets them bid directly on federal work instead of just posting jobs for it. They're turning a job board into something that sits inside the defense hiring pipeline. Almost no one on Wall Street covers this stock. And the only person on board is actually in the top 2% of all analysts for his stock picking performance, meaning that when he picks a stock, it pays to listen. And in this case, he's got a price target for DHX, get ready for this, that implies more than 150% upside potential in the year ahead. Our best bet for appreciating the virtue of any underfollowed stock is to put them through the full 115-factor analysis of the Zen Ratings model. And as you guess, in this case, DHX sparkles with an overall Zen rating of A, equivalent to a strong buy recommendation. Now, on the whole, it's in the top 2% of all stocks we track, given its fundamental prowess. Once again, we want to drill down to the specifics of the component grades to appreciate the unique facets of this stock. We're talking about top 25% of all stocks for growth and top 24% for value. That's a pretty good start, but it keeps getting better. Now consider the stock is also top 12% for financial strength and another top 12% for momentum and top 4% for sentiment, tracking the smart money activity in the stock. Now, as a reminder, the Zen ratings are updated daily, so be sure to visit the quote pages on WallStreetZen.com to see the latest ratings for this stock or any other. The downside to this investment is straightforward. If the defense hiring tailwind stalls, then it harms their outlook. But all in all, DHX has a truly unique economic moat with clearance jobs, the benefit of which shines through their top grades of the Zen ratings. And let's not forget the analysts pounding the table for 150% upside in the coming year. That's the kind of quiet setup that tends not to stay quiet for long. Quick ask before we move on to our next pick. If you're getting value from this breakdown so far, then please hit subscribe and turn on the notification bell. That's because I publish data-driven stock analysis like this every week, and that's the best way to ensure you see the next one. Let's forge ahead with stock number 4 in Ironwood Pharmaceuticals with a symbol IRWD. If you believe that all low-price stocks are just speculation, then this one represents a noteworthy counter-argument. Ironwood Pharmaceuticals is a GI-focused drug maker anchored by its flagship treatment for irritable bowel syndrome, which generates steady, reliable cash flow. Now, this is not a clinical stage biotech burning money and praying for a favorable FDA decision. Ironwood currently sells real products to real patients for a real and attractive profit. And that's exactly what makes this low price tag so strange. Because looking at the numbers, these appears to be extremely cheap shares. Now, the best way to see them is via the PEG ratio, which tells you how much you're paying for all the earnings growth. A PEG around 1 is considered fair value. Ironwood sits under 0.2. That's the market pricing the stock as if it's barely growing, when the earnings picture says exactly the opposite. So what does Wall Street think the stock is worth? The analysts covering it have an average price target that implies the stock could nearly double from here. But the maximum forecast suggests it could see over 150% upside in the coming year. And these analysts aren't randos. One of them, the most bullish price targets, came from Jason Butler of Citizens, who has ranked the top 2% of all analysts based on his actual stock picking track record. Now, the Zen ratings analysis confirms the stock's overall strength. Ironwood earns an overall A, strong buy recommendation. That's because it scores in the top 3% of all stocks for its fundamental profile. As we drill down to those component grades, it shows strength in a variety of areas. All right, starting with growth, it ranks in the top 6% of all stocks we track. Then it scores in the top 2% of stocks for financial strength. But its value grade of A is about the best you can get, ranking the top 1% of all stocks. Sentiment and safety scores are a bit softer, and that softness ties directly to the risk. Ironwood carries meaningful debt load, something management has to actively manage over the coming quarters. Now, no stock is without risk, but Ironwood is a generally profitable company with great grades for value, growth, and financials, plus top-notch Wall Street analysts calling for tremendous upside in the year ahead. Yet another compelling opportunity for you to consider. Before I get to that last pick, if you enjoy this kind of stock analysis, then you need to join me for my next live training session this coming Monday at 7 p.m. Eastern Time. I like to kick things off with a timely market update plus a training plan to outperform. Then I finish up strong with my trade of the week, combining the best of the Zen ratings with my greater than 40 years of investing experience. Now, it's free, but you do need to register. So just go to WallStreetZen.com/live or click the link in the description or scan the QR code on the screen. I look forward to seeing you there on Monday. Now it's time for our final and arguably most exciting pick. That brings us to stock number 5 in Riskified with the symbol RSKD. Here's something you almost never see in a company this size. Riskified is spending serious cash. I mean $450 million to aggressively buy back its own stock. But remember, this stock only has a market cap of $750 million. Think about what that signals. The people who run this business, who know it better than any analyst ever will, are looking at the stock price and deciding the best use of their extra money is buying more and more of their own stock. Clearly, they are confident in more growth and share price upside ahead, and maybe we should be too. But let me back it up. What does Riskified actually do? Fights fraud for online stores using AI. Now, when you check out somewhere online, a system has a fraction of a second to decide if you're a real shopper or a thief using a stolen credit card. Riskified makes that call and does something unusual. It backs it up with a guarantee. If it green lights a sale that turns out to later be fraud, then Riskified pays for it, not the store. You only make a promise like that if you're confident your AI is the best in the business, and that confidence is their whole product. And that timing matters because fraud is about to become harder to detect as shopping shifts towards AI assistance. Placing orders for us, the criminals get the same tools and the threat scales up. A company that can credibly guarantee fraud protection is going to be in high demand, the benefit of which is already starting to show up very clearly in their quarterly earnings reports. Now, we're talking about 4 straight quarters. Riskified has come in ahead of Wall Street earnings expectations. Now, think about that. Each time they beat, expectations then got ratcheted up and they beat that again. Even with this impressive earnings momentum, Wall Street has barely shown up to take notice. Just one analyst covers the stock on WallStreetZen.com. Now, for some investors, almost no coverage is a reason to stay away from shares. But it could also be just simply an indication that Wall Street has not yet discovered the story yet. And when they do, then they actually, each new buy recommendation acts as a catalyst to push shares higher. This benefits the early movers. So if Wall Street isn't saying much, then our best bet is to rely upon the Zen ratings. Indeed, Riskified earns an elite A rating overall. That's because it's in the top 3% of all stocks analyzed by the model. As we look at the component grades, we start the party off with the top 20% showing for financial strength. This is often a sign of management effectiveness. Next up, we have a top 5% showing forward-looking AI grade. Now, remember, that grade isn't about how much the company is involved with AI. Rather, it's our use of AI to spot patterns in the stock's behavior that typically points to future outperformance. Now, the headline grade is growth in the top 2% of all stock we track. This is the best possible clue of more beat and raise earnings reports ahead. The risk is that this is the only company on the list today that isn't consistently profitable yet. So it's the most speculative name here, and you'd want to size any position accordingly. But let's get real. The company is well positioned for the future of online commerce, has a sparkling fundamental review from the Zen ratings, and management is buying back shares hand over fist. That makes this a special opportunity under $5 per share. So there you have it. 5 stocks trading under $5 that look nothing like the junk that falls normally into this category. Each has a compelling setup that says it may not stay under 5 for long. So if you are interested, then you better act soon. Remember that every one of these stocks scored highly from the full 115-factor review of the Zen ratings model. You can pull a free rating on over 4,600 stocks yourself just by typing in a ticker at WallStreetZen.com. So be sure to bookmark the site for frequent future visits. Now, I want to hear from you. Which of these penny stocks seems like the best opportunity to you? And are there any other penny stocks that I didn't mention that you have your eye on? Share it with the rest of our community in the comment section below. If you're hungry for more under-the-radar stocks, then check out the video popping up on your screen right now.